Hi everyone, this is Chandeep Kapoor. Welcome to another ETH weekly options trading video. In this video, we'll be discussing three options trading strategy which you can take for this week, which is the expiry of 6th October. So as we can see from the 18th August, Ethereum has maintained a very narrow range and it is continuing to do so and will continue to do so in absence of any major news or event. So we have marked two ranges on our Ethereum chart. The narrower range is from 1600 to 1700, and the wider range is from 1500 to 1800. That is 100 points more safety on both sides. So if you look at both ranges, the outer range has not been tested yet, and outer range has roughly maintained a safety of 50 points from the price movement of Ethereum. And inside the narrow range, so Ethereum has stayed inside this range for most of the time, except for going out uh, to 750 here, a small wick here and there. So based on this, we can take a range bound sideways market trade. And best trades to take for a range bound or a sideways market is a short wall short options trade. So this is the weekly option chain of Ethereum, and we have covered three strategies in this video. So let's go through them one by one. So the first strategy which we are going to cover is the safest strategy, that is the 1500 and 1850 short strangle. So if you look at our first trading strategy, that is the 1500 and 1850 short strangle. So this is the chart of that strategy. So as you can see in this strategy, uh, our short strikes are placed at 1500 and 1850, and the break evens are also much wider than the two standard deviation mark. The total premium received for this strategy is $2.3. And similarly, for those people who want a higher return and are willing to take a higher risk, they can take options uh, 50 points inside this range, which equals to 1500 and the 1800 short strangle. So if you look at the 1500 and 1800 short strangle, the break-even marks is slightly around this two standard deviation mark, and the premium received is also higher. So if we compare both of the strategies, both strategies are going to employ a $33 capital, while the 1500 and 1850 short strangle is receiving $2.3 of premium. The other strategy is receiving $6 of premium, which translates to approximately 7% return on capital and 18% return on capital. And of course, with higher return on capital comes a bit of higher risk. So as you can see, the 1500 and 1850 short strangle is way outside the two standard deviation mark. The break even of this strategy and both the strikes are way outside the two standard deviation mark. So we can say that the risk profile of this strategy is less than the two standard deviation risk mark, which is a very standard risk measurement tool which is used while trading. And while the 1550 and 1850 short strangle is roughly around the two standard deviation risk mark. Okay. Another strategy which one can consider for this kind of market is a mean reverting call selling strategy. So, what is the meaning of mean reverting? So, mean reverting means that you sell an asset which is going higher and you buy an asset which is going lower. So, which is again the buy low, sell high kind of a strategy. And this is opposite to the general trend following strategy which most people do, that is buying an asset going higher and selling an asset going lower. So since, as you can see, Ethereum is on the top end of our range, a strategy which we can consider taking is selling a call option on the highest point which Ethereum has maintained in this range. So the highest high which Ethereum has achieved is around the 1750 mark. And for those looking to take a mean reverting strategy and people who believe that Ethereum will go lower from this point on and still continue to maintain its range, can sell the 1750 call option. This is the chart of the 1750 call option sell, and this is a single directional trade. So this is not hedged or risk managed by selling the put option. This is just a naked call sell. And as you can see, the break even point lies between the one standard deviation to two standard deviation mark, which also makes it a bit higher risk strategy. And the capital employed will be half since we are only selling one option, and the ROC will be higher since we are taking more risk.